Hello, and welcome to our live webinar on how to meet your financial goals with mutual fund investments. Well, all of us have dreams and we have our own goals. It may be something like, going on a dream vacation or buying a small car or be it a home. Some of us want to plan ahead for our children's education or even for retirement. But how do we go about doing this? Whatever your goals may be, mutual funds offer something for each and every one of us. But with so many different types of mutual funds available, where to invest, how to invest, and when do we start investing? These are questions that most of us have. So today we have with us Dr. Renjith R G, Associate Director, Geojit, and Sriram BKR, Senior Investment Strategist, Geojit, to help you find the right, to talk to you and let you know how you could find the right mutual fund and when you can start investing and why you should stay invested. We'll start the session uh, with an introduction by Dr. Renjith R G. Renjith has been with Geojit since 1999. And with his vast experience, he has been interacting with clients on various topics related to equities, mutual funds, insurance, and more. So over to Renjatarji.
Thank you, Josie. I hope I'm audible. My voice is clear.
Yes.
Thank you. So well, good evening to all of you. On behalf of Geojit, I take this opportunity to thank you for joining us during the busy schedule and making certain that you're a part of this event. Our endeavor would be to make certain that you have a lot of value addition after attending this webinar, and we would be augmenting you in your efforts to create wealth in the long run. So I will just give a brief introduction of just to set the context right. I just give a brief introduction about what has happened in the market the last, say, a year. And afterwards, we will go in for a presentation. And post that, we'll be happy to answer any of your queries with respect to investments in mutual funds and SIPs. Well, you know what's happening in the market as of now. A quick recap. We all know that Nifty and Sensex delivered fantastic returns in the last financial year, that is FY22. 19% was the rate of return what both these indices has given. And if you look at what is happening in the market as of FY23, that is YTD as of July, we are down around 2% as far as returns are concerned. We all know why it is happening. It's primarily because of something that seriously went wrong in the geopolitical scenario, the war between Ukraine and Russia, that has taken a toll as far as the global financial markets were concerned. Supply chain disruptions and increase in commodity prices resulted in inflation. And most of the central banks across the world tried the level best to contain inflation by increasing the rate. And that had an impact or adverse effect as far as the markets were concerned. Global markets were volatile the last 4-5 months. Primarily because of what I told you in the beginning of what went wrong in the geopolitical environment with a impending war between Ukraine and Russia. Oil prices soared, resulting in higher inflation across the globe. As I told you, to counter inflation, central banks started increasing the rate of interest, including the RBI of India, and that has resulted in the increase in the rate of rate and the increase in the rate in the US sort of makes certain that the FPIs who have invested in the country, they started withdrawing their funds from India at a increased pace. And that had a bad bearing as far as the exchange rate rupee was concerned. And the rupee tanked to almost 80 rupees against the dollar and is still weak. In the meantime, Sensex swung between 61,000 odd levels in the month of Jan to 52,000 in the month of March, recovered to 60,000 in April, again tanked to 51,400 in June. Since then, post June, the market has recovered to 58,000 points. That is almost we have seen a recovery of almost 8 to 9%. So, in a nutshell, the scenario has been volatile. such volatility has created some sort of confusion, question in the mind of investors regarding what is the ideal thing I should be doing in such volatile situation. Whether I should stop investing, whether I should take the money out, or what is ideally I should be doing due to such volatile situation. The webinar here, our objective is to give some concrete answers to your apprehensions or questions with respect to the volatility and what is there in store as far as investors are concerned. Coming to the mutual fund industry figures, equity categories saw an inflow of around 15,000 crores in the month of April, followed by almost 18,000 crores in the month of May. June, it was around 15,500 crores, but July, we have seen an inflow going down to 8,000 crores, primarily because, as I told you, the markets went up almost July and August markets went up almost 7 to 8%. And we saw some amount of profit booking happening in the frontline stocks as well as in mutual funds. And the inflows have sort of subdued it to a bit. That has resulted in the inflows getting down to around 8,000 crores in the month of July. But the silver lining is that the good thing is that SIPs are still showing some trend which is healthy in nature. SIPs, by the inherent nature of the product, is something which you can own during any market circumstances, primarily because if the markets tank, if the markets goes down, you may gain more units. And if the market goes up, you tend to make fantastic return on the units that are garnered at a lower price. But SIPs, we have seen the SIPs inflows at almost 12,000 crores during July. That's a healthy trend. So this is that has happened in the market. This is what has happened in in terms of inflow, in terms of SIPs in the mutual fund industry in the last couple of months. And now I request my colleague, Mr. Sriram Bhikya, to talk to you regarding how well you can channel investments towards attaining your goals, financial goals. And post that, we will get into a Q&A session. Over to you, Sriram. Thank you very much.
Hi. Okay, so thanks, Renjith sir, for setting the context right, and good evening, friends and clients, and I welcome you to this webinar. So today, what we will be doing is so let's look at the flow in two ways. One, first we will talk about how equity behaves as an asset class, and we will have a very detailed approach, or I would say an observation on the timing part of it. So just to take a few information from what Dr. RG told in the introductory remarks. So between Jan 22 till July 22, we have seen a very volatile market. In nutshell, what happened is in January, it was about like 61,700 level. I'm talking about Sensex here, the price index, and it fell to about 52,000 odd levels in the month of March, post the war situation that broke between these two countries. And then it recovered in fact, in the month of April, that was a very sharp recovery. It again crossed 60,000. And again, it fell close to about 51,000 odd levels. And now we are back to around 58,900 odd levels as we speak today. This means a lot, in fact, because what happens is, when market tanks and kind of consolidates at one particular level, it's a different point altogether. But when it becomes more volatile, what happens is it creates questions like, the most important thing is the timing exercise. So today I would spend little time in terms of what we have observed as far as this timing exercise is concerned. And post that, the second part of the webinar, I would be speaking about the various categories that are available in the industry today and how you can plan for your goals with them. So with that, let me first share the presentation, and just give me a while. I will now start with the first part of the presentation. So this is something Dr. RG covered, so I'm not taking it through again. So let's first talk about the starting point, right? So why do we invest? Investment as an activity. What are the logic or the objective behind it? So basically, it is preparing for the goals, right? And what are the goals that we have? So broadly, these are all the goals anybody would have, and I think predominantly everybody would have this. like children's education, retirement, asset purchases, like what Jyoti mentioned in the opening remarks. So for all of these goals, we try and prepare ourselves when we are going to meet them. Right. So hence we do this activity called investment. And what are the basic investment expectations we have? First and foremost is safety, liquidity. We try to get better returns beyond inflation. And the investment should be tax efficient. It should give you a reasonable amount of diversification as well. And also it should have a ease of access. Now, all this investment are oriented towards a goal. And I think the first starting point of goals should be to classify them by the duration, right? Once you do this, then planning the investment becomes relatively easy. So as long as you are able to divide your goals or classify your goals in terms of duration, like short term, medium term, and long term, your investments can be aligned with that. So what we have seen in the market over a period of time is as long as your investments are aligned with the goal's duration, such investment experience are pleasant. So that is something which we have seen across market cycles as well. Now, what are the various investment avenues? These are all very prominent and a little simple kind of an information most of us must be knowing. So broadly, these are all the three asset class with which every Indian probably invest more actively, right? So you have fixed income. Under that, you have the most famous products like fixed deposit, public provident fund, NSC, recurring deposit, etc. And then you have the non-traditional fixed income options like the debt mutual funds. And then coming to precious metal, you have the options of gold, silver, etc. And coming to market linked products, you have the instruments like equity shares. These are all mostly non-traditional equity shares, equity mutual funds, etc. Now, let's see quickly how these asset classes have performed over a period of time. And this is one reason why we try to emphasize the point of equities, how you should be looking at the equity investment as a whole. Right. So we will first look at the performance of them. This is a very, very popular chart, by the way. This simply talks about the return from different asset classes. And the transaction is if you are investing every year. So this is the transaction basically. So if you are investing every year, how the investments have performed over a period of time. So I will pause here for a while. You can observe in the meantime. So as you can see from the table, it's in the heat map format. Equities would have outperformed the other asset class over a period of time. So this is something which we have seen. And uh, and if you look at the next best performing asset class from the Indian context when we speak, it is the gold and silver. So gold and silver has kind of given a fantastic return. And let me also tell you that when I speak about gold and silver here, I'm actually not talking about the physical ornament. I'm actually talking about the electronic way of investing in these instruments. So that would have given you this kind of a return over this periods. So this is something which is, this is something which everybody knows over a period of time. But what is more interesting is about the way the equity returns are delivered. So this is the returns. While this is looking very attractive in the long term, the returns are delivered in this kind of a manner, more or less. So the chart in front of you again is a very popular chart. This actually talks about the journey of Sensex since inception all the way till June 2022 with all the events that would have triggered a correction in the market. So I will again pause here for a while so that you can take a glance, a glance to this. So with all the events, then you have the milestones that are getting achieved over a period of time. So this is something which is very, very important for us to understand. Something went off in between. I also could not understand. So, okay, great. So now what we were speaking about is, or what I was explaining is the way equity returns are delivered. That return itself is volatile in line with the chart that you are seeing in front of you. So there are a lot of events that probably will trigger a correction in the market. And every time market drops, there is a variation on the return as well. Right? Now, let us try and see how frequently this correction occurs. How frequently does market correct? Markets decline almost every year. If you were to normalize the previous chart by calendar year format, markets correct every year. Sometimes it is price-wise correction or time-wise correction or both. Now, if you see 2022 till July, markets would have reached the lowest point of minus 16% that spread over a 5-month period, and uh, like so on and so forth. Like you can see the previous years as well. So if you look at in summary, the average drawdown over this 36-year period, starting from here till 2021, let us talk about the full calendar years instead of 2022. I'm excluding that. So over this 36 years period, the average drawdown per annum per year by on Sensex, what we have seen is about 22%. That's drawdown means fall, the correction that we are talking about, market drop, right? And the average correction duration is about like 4.5 months. For 10-year period, drawdowns spanned more than 6 months. 17 years, drawdowns were beyond minus 23%. And 3 years, only 3 years drawdown, if at all it happened, that correction was less than 10%. And 7 years, multiple drawdowns were there as well. So this is not the first time markets are actually seeing this kind of a correction. It happened in the past. It occurs almost every year. The only thing is the magnitude differs here and there, and the correction period also varies. All right. Now, if you see how the calendar year ends, like this is the intra-year correction of the market. And if you see how the year-end closing of Sensex been, 72% times it closed positively. All right. Adding more investment to the portfolio during corrections get rewarded handsomely in the long term. This is a very, very important point that I would like to emphasize here, right? So intra-year it could have corrected. For example, even say 2021, last year, right? Intra-year, this is the most worst correction that market have seen. It has corrected only by minus 9%. Nevertheless, in terms of magnitude, it is relatively less. But still, end of the year it closed positive. So intra-year there could be correction. End of the year it closed positive. More or less it happens across the or most occasions it occurs like that. I would put it that way, right? So this is something which everybody should understand, or we would like to emphasize that market corrects almost frequently or almost every year. We see that correction. Now, what is the timing aspect around this? Where I'm coming to is this is the classic risk of timing the market. So let us first try to define the word timing the market. What does it mean? It's an attempt to avoid all the market fall and participate only on the upside. It is more easily said than done, right? Or in a more plain note, we will sell the holdings. We will sell all the holdings or investment when markets appears troubled and re-enter again when everything looks okay. This is also easily said. It looks fine when you theoretically say that statement. Now let's see how does it work or how possible is this, right? Now, in order to understand this, let us take a transaction, right? So somebody invested 5 lakh rupees in Sensex in Jan 2002. And what is its value and the return as of December 2021 in different timing scenarios? The first scenario what we will talk about is no timing, which means somebody invested 5 lakhs in Sensex in Jan 2002 and simply held it intact till December 2021. All right. The CAGR for this period is about 15.5%, and that 5 lakh rupees would have grown to about 89.3 lakhs. This is no timing. Invested, kept quiet, held till December 2021. No timing activity. Now, let us first talk about the reward of getting the timing right. So what we understood about timing, you are trying to avoid a worst time and try to be with the best time only, right? That is the idea of timing. So what if you are so lucky to get the timing right all the time, right? So your no timing is 15 and a half. If you miss the 10 worst days, which actually is what we are trying to do in timing, right? 10 worst days we are avoiding. Our CAGR jumps to 20.8% from 15.5. Just 10 worst days you miss, your CAGR phenomenally jumps. Looks very good. Or so on and so forth. Let us talk about say 20, 40 worst days. If you miss 40 worst days, your CAGR doubles. And this is the value, right? So if you just wanted to read it right, it's about 10 crore. Yeah, 10.3 crore is the kind of value you are creating. If you miss 40 worst days in this 20 odd year period, right? Looks fantastic. This is the reward of getting the timing right. If you miss the worst days, few worst days. which is, of course, a kind of calculation that we are trying to say here. Now, let us talk about the risk of getting the timing wrong. This is the reward of getting the timing right. But what if you get the timing wrong and end up miss the 10 best days only? Your CAGR drops to 11. And if you miss 40 best days, your CAGR drops to about 3%, which is less than the savings bank account rate. Right? This is the reward of getting the timing right, and this is the risk of getting the timing wrong. And now let us see the high possibility of missing some of both. I would like to attribute a word high possibility. I will come to that later. Why I am saying this as a high possibility. Let us assume if you are missing some of both. If you stay with most of the worst days and some of the best days, you miss them, your CAGR jumps. And if you end up missing most of the best days and few of the worst days, your CAGR is here. And if you equally miss them, your CAGR is almost close. First, we spoke about reward of getting the timing completely right. This is completely wrong. And this is sum of both. Now, why we are saying this as a high possibility is the reason is while avoiding the worst days looks very rewarding, the probability of getting it right is very, very difficult. Why? Between the same period, 2002 to 2021, the best 50 days and the best worst 50 days occurred within 5 days. 50% of the times. That is, in this 50, put together is 100. Almost 50% of the times, these 2 days occurs within 5 days. Both of them equally spread. Best days and worst days are equally spread between those 5 days in 50% of the times, and 88% times it occurred in less than a month. That means the best day, worst day comes within 5 days or within 1 week or within 15-20 days or within 1 month. 88% times it occurred within 1 month. Hence, investors trying to avoid the worst days, this is what we are anticipating. Actually, this is what we are wishing to do. Investors who are trying to avoid the worst days stand higher chances of missing the best days as well. Right? So what we are trying to do, we will try to avoid the correction. We will try to avoid the fall. We will try to avoid the drawdown. This is what we are trying to do. But please understand, my dear friends, the best days occurs only during that time, most of the time, occasions. I will now take to you to the next slide. Again, I will come back to this slide. This is how that breakup is. So just to give you a context of what I'm talking about, this 50 days is there, right? This 50 days, best 50 days. Let us talk about the spread of that here. This is the Sensex breakup of the best 50 days between this 20 years period, right? 88% of the best days were during the drawdown or near the recovery cycle. Talk about 2002 and 4, talk about 2006, talk about 2008. 48% of the entire this entire 20-year period, that 48% of that best days of 50 best days occurred in this period. This is the entire bad period. It was full of correction. Sensex started somewhere around 20 to 21,700 odd levels here and crashed till about 8,000 odd or 9,000 levels here and then recovered. So the entire, out of the entire history, 48% best days were here. 2009 and 2019 recovery. 2020 pandemic and 2021 recovery. So net 6, 8, 48, 12, 14 adds up to about 88%, and only 12% of the best days were scattered here and there. So my dear friends, please understand, it is only during the drawdown or the recovery times, at times you get this best days, and best days contribute significantly to the wealth. Only few days that contribute significantly to the wealth, and no timing, 15 and a half. Right? Now, all this transaction illustration that we are talking about excludes the trade cost and the possible taxes that also can be incurred in the process. Right? Hence, for long-term investor, staying invested works well. Simple. You are buying and holding it for the goal. You have a goal. Your goal is constant, or it varies from here and there. It varies here and there with some of the cost variations over a period of time. But goal is there. You stick to your goal and give the time to the investment. Instead of getting too much bogged up or worried about the market falls and why you wanted to, what you wanted to do, or whether you wanted to participate in that market fall and rise. That is actually not much needed, except for one activity that when there is a significant drop in the market, you try to add to the investment, add more to the investment. That will reward you well in the long term. So I think with this slide, we would like to summarize only simply one point. If you are a long-term investor and you are investing for a goal, stick to that. That is very important. Staying invested works well instead of getting worried about the market correction, instead of getting worried about the negative news, instead of trying to avoid that correction and re-entering later, because by the time market recovers, you are already missing the best days. That's what we are trying to say. And the illustration very clearly says that even if you miss 30 best days, let us talk about 30 best days only, somewhere in the middle, right? Your CAGR drops significantly. So this is the possibility of your wealth creation. And this is what we are worried. Or this is what probably is the result because of our worry, right? So I think it's ideal that you stick to the goal. That is very, very important. So how long is long term? What is the ideal time period to invest in equities, right? So this is again a very popular chart. I'm just taking an extract out of it. This chart actually talks about the possibility of profit and loss in Sensex with different investment duration. Just to put it in perspective, if you are staying invested in Sensex for about 1 year time, 71% times you have chances to make money and 29% times you lose money. On the other hand, you move the needle to 5 years, 94% times you make money and 6% times you have chances of losing the money. Move the needle to 10 years, 99% times you have chance to make money and the possibility of loss comes to almost zero or zero itself, right? This is the first observation we have, which means in the long term, risk of loss reduces and the probability of profit increases. The second significant observation is returns becomes less volatile. Historically, in this 36 and a half year period, any 1 year, between any day to any day, from 1986 till to June 2022, any day to any day, if somebody stayed invested in the market for 1 year, the best return is 263%. And if you rank this entire observation by as a descending order, the highest return in the top and the worst return in the bottom, the worst return is minus 56, the average is 20. Come to 10 years. The best return itself is 26% CAGR and the worst return is minus 3 and the average is 14. Right? So the returns becomes less volatile with the longer the, with time, I would say. The longer the time period, the returns becomes less volatile. And the probability of returns beyond average inflation goes up. So in a 10-year period, if you want to see how much times you make money beyond 7%, that is about 87% times. And how much time you make returns in double digit, that is about 75% times in the long term. So the long term, the probability of double digit return also goes up in the market. So I think it's very important for us to keep the goals in mind and intact. Your keep investment should be kept intact for that goal. And if you are participating in equity, be aware of this volatility and try not to avoid the correction entirely because best days comes within that. It's very difficult to capture them. That is the reason we time and again say timing is very, very difficult and it is a very risky proposition. In order to achieve this, if you miss this, then the results are not up to the mark. So, summarizing the first part of the day or first part of the webinar, the risk people take with their money. I would like to summarize that into two parts. Keeping the money needed within the next 1 to 3 years in equity. It's a bad idea, big mistake. Sometimes it will work, sometimes it terribly fails. It is not a good idea. Keeping the money that is required after 10 to 15 years in fixed income. This is again a big mistake people do, right? This ideally should be the money. If your goal is about like 7, 8 years, 10, 12 years away, I think ideal asset class for achieving that goal should be equity. Now, how can you plan for your goals with mutual funds? So for people who are attending for the first time, in order to help them, let us first understand what is a mutual fund. It is an investment vehicle that pools money from various investors and invests the collected funds in securities market. Every scheme has a common objective and that also describes its investment nature. It is an indirect route for investors to access both equity and debt market. very professionally managed. It gives you good diversification across different sectors at a very low cost, highly governed and regulated by SEBI. It has a good level of transparency on investment and periodic disclosures. Indian mutual fund industry is highly transparent. Investment made by the investors are represented by way of units, and the price at which you buy and sell, that's called net asset value. NAV represents the net market value per unit of the investments. Hence, NAV moves up or down in line with the market value of the underlying schemes also. So if technically, if market becomes volatile, your NAV also is volatile. If market goes up, NAV correspondingly goes up. If market or the underlying portfolio comes down, NAV also drops. Now, what are the different types of mutual fund we have? You can classify the mutual funds in India by maturity or the fund management style or by asset class. By maturity, it's fairly simple. You have closed-ended fund or open-ended fund. And by fund management style, it could be classified as active or passive. And by asset class, it could be either equity or debt or hybrid, solution and others. We will speak about this in detail today. Now, first we will talk about the fund management style. As we know, it is either active or passive managed fund. What is an active fund? It is a fund where fund manager or the investment team does research on companies, evaluates performance and take active buy and sell decisions. That's called active fund. In a passive fund, fund manager builds a portfolio that mirrors a popular market index, select Sensex 50, Nifty, Bank 50, Nifty, IT, etc., etc., etc. So it is basically a fund that represents an index. So there is no active buy sell decisions by the fund manager in a passive fund. In active fund, active management, active buy call and sell call will be taken by the fund manager. Now coming to the classification by the asset class. First is an equity fund. So what is an equity fund? As the name suggests, it predominantly invests in shares or stocks of the companies. Equity funds could also be either active or passive. Equity funds can be further subdivided as per their investing style as market cap based, strategy based, sectoral funds or tax saving fund. Whom it is suitable for? If people are having long-term goal planning, growth-oriented expectations, tax savings, long-term capital appreciation, etc., they can look at equity funds. What are the classification for that? So before understanding equity funds, we will understand what is the market cap classification that is adopted today in the Indian mutual fund industry. So in the context of equity mutual fund and from the point of view of investments, stocks are classified by their total market capitalization as large cap stocks, mid cap stocks, and small cap stocks. It is based on their total average market cap of 6 months. Right? Now, when you rank them by the total average market cap of 6 months time, all the listed companies, the first 100 companies are called large cap stock. 101 to 250th, this counts to 150. That is called small cap stock. 251st company and onwards is called small cap stock. One more time, very slowly. You rank all the companies, listed companies by the total average market cap of 6 months. First 100, large cap. Next 150, mid cap. 251 and onwards are called small cap. And where this list is given or who does this exercise? AMFI publishes the list of stocks by average market cap as guided by SEBI. And what is the duration in which it is given? In January and July. January consists of the detail of the preceding 6 months data, that is from July to December. And July publication will have the data for the preceding Jan and June. All right. Now, change in market cap category of a stock can possibly result in funds making changes to their portfolio as well. For example, if there is a stock that is classified in any one of this category for the period of July, December, and in the Jan, June list, their position gets migrated, which means the fund which is invested in that stock also will have to make change in their portfolio as well. So this one activity will lead to minor changes of stocks here and there. It is like a index rebalancing or something like that. But in effect, it's a activity a fund manager will carry out due to the change of market cap classification by the according to the AMFI rule. Now, coming to the subcategories. So we know that equity funds are of four types: market cap based, strategy based, tax saving, and sector funds. So market cap based funds can be further subdivided into six: large cap funds, mid cap fund, small cap, large and mid cap, flexi cap, multi cap. What is the large cap fund? You now know what is a large cap stock. So large cap fund will have to invest minimum 80% in such stocks, which is the top 100 companies by full market cap, or the 6-month total average market cap. We can call it that way. Mid cap fund, minimum 65% should be invested in mid cap stock. What is a mid cap stock? The next 150 companies. And small cap fund will have to invest minimum 65% in small cap stock. And what is a small cap stock? 250 first company and onwards by the total market cap. Large and mid cap, they will have to invest minimum 35% in each, in large and mid. Remaining 35 plus 35 adds up to 70. The remaining 30 could be in any other cap. Flexi cap fund, they don't have a cap constraint. It is a dynamically managed fund, dynamically managed equity fund, you can call it that way. So they have to minimum invest 65% in equities and related say instrument. So they invest across large, mid, and small cap stock dynamically. Coming to multi-cap fund, which is relatively a new entry into the mutual fund categories in India, minimum 25% should be each in large, mid, and small cap. The remaining 25 could be in any other cap. Coming to strategy based, you have dividend yield. They again don't have any cap constraint. They should have minimum 65% in equity and related instrument, but they should be predominantly investing in dividend yielding stock, value fund or contra fund. So what happens in Indian mutual fund industry today is a mutual fund house, a company, a AMC, asset management company, like the names that you have like Mirai, Kotak, SBI, HDFC, etc. They can have only one scheme in one of these category. So in the case of value fund or contra fund, they can offer any one. So either they follow the value investing strategy or a contra investing strategy. They also don't have a cap constraint. They should minimum invest 65% in equity alone. Coming to focused fund, it is a very concentrated portfolio. Unlike the other diversified mutual fund, focused fund will have a very concentrated portfolio. The rule is they can have maximum 30 stocks only in that. They also don't have any cap constraint because it's only minimum 65% in equity and related instrument. Coming to tax saving fund, it is famously called as ELSS, Equity Linked Savings Scheme. They have a 3-year lock-in period and they give you tax benefit under Section 80C up to 1.5 lakh per annum. Coming to sector or thematic fund, minimum 80% in that sector or theme that is mentioned over there. Coming to debt fund, they are also called fixed income funds. It's a fund that invests predominantly in fixed income instruments such as a corporate bond or a government bond, corporate debt security, money market instrument, etc., etc. The advantages of investing in debt fund are its low cost, relatively stable return, high liquidity, and reasonable safety. Debt funds are also less volatile as compared to an equity fund. Debt funds are less volatile as compared to an equity fund. That's a very important point. They offer indexation benefit. I will talk about this in the next slide. I will give you an illustration also. So debt funds broadly are classified as duration funds or instrument-based funds. And this duration is calculated by a technical term called Macaulay portfolio duration. From an investing standpoint, we need not have to know in detail about this. You are always welcome in terms of understanding or improving the knowledge level. But all it important for us to understand when you are trying to classify or understand what or how the classification is made in a debt fund, they use the portfolio methodology called Macaulay portfolio duration. This again is a methodology that is stipulated by SEBI so that all the fund house follow the same methodology for uniformity purpose. Whom it is suitable for? It is ideal for investors who are aiming for regular income but are risk averse. Helps investors plan for short-term or medium-term goals ranging from 1 day or 1 week all the way to 3 years, 5 years, or even longer as part of your asset allocation, all in a very tax efficient manner. Now we will speak about indexation with an illustration, right? It's a very busy chart. I would like to take your focus on this particular table. This simply talks about the transaction in a FD and debt mutual fund and how it creates a difference in terms of your tax outgo. Simple point. So the transaction is very simple. March 2017 20th, somebody invest 1 lakh in this and this. So there are three people involved here. One comes in the 10% slab, 20% slab, and 30% slab. And the maturity is done on the 9th of April 2021. The value is 1,30,000. A lakh of rupees invested, matured at 1,30,000. The 30,000 rupees is the gain, right? This is a simple point. Up till now, everything else is same. If you convert this 1 lakh to 1,30,000 growth over this particular period, the returns are about 6.68%. I hope till now it is clear. It's a plain vanilla simple transaction. Now, coming to the taxability part, for a person in 10% tax bracket, the entire 30% is taxed at 10%, right? So you get there is a tax burden of about 3,000 rupees here. Now for a person at 20%, 20% is paid on this 30,000 and here 30,000, 30%, right? So net for a person in 30% tax bracket, so upon 30,000, 9,000 should be the tax outgo plus your additional cost or cess, etc., etc. That is all excluded in this illustration. It's a very simple illustration that we are talking about, right? Now this is the FD transaction. Now you come to debt mutual fund, right? There is something called as indexation benefit. We spoke in the previous slide. Offers indexation benefit. What is this indexation? From the year of investment till the maturity of investment, whatever was prevailing as the cost inflation index, that is adjusted. So your investing year cost inflation index was 264. The sale year is what? If April 2021 means it falls in the financial year 21-22. Investment occurred in the year 16-17. Right? This is March 2017. So this falls under the financial year of 16-17. Sale happened in the financial year 21-22. When you adjust this to the purchase price, 1 lakh is inflated for this CII. Your new indexed cost of investment is 1,20,000, not 1 lakh. From the income tax angle, your new cost of investment value is not 1 lakh, it is 1,20,076. Now, when you adjust your sell value to this index cost, your gain is 9,900. On this, when you pay 20% tax, this is your actual liability. Post tax, your returns are still healthy. Mind you, colleagues and friends, this CII has moderated over the last 5-6 years in India, except for the last 4 months when we are seeing the inflation again shooting up. One more time, I tell very slowly. Over the last 5-6 years, inflation has moderated kind of as compared to the inflation that was prevailing a little earlier, right? So even in a low inflation environment, your tax outgo gets saved or tax outgo comes down. So from the long-term perspective or from the point of view of your overall fixed income diversification, I think debt mutual fund can have a tax efficient place. I hope indexation part is little clear. I would also, if you have any queries, you can write in the chat box. We can take it up at the Q&A time. Now, key points to keep in mind while investing in a debt scheme. Debt mutual fund offers advantages over other traditional fixed income products, but they also come with market rate or overall market, interest rate, liquidity, and credit risk, as explained by us in various occasions. So we keep informing or sending out notes and articles around the way debt funds are going to be looked at, or the way you should be considering investing in debt fund. So there were a couple of occasions that we have done that in the past as well, and we periodically do that, right? These are all some of the primary factors one should consider. First, credit quality of the portfolio. How much of the instrument in the portfolio are AAA rated or sovereign or others? Coming to YTM, or called yield to maturity. It's a very important factor and that relatively changes with duration. Average maturity and the modified duration, which is relevant to understand the possible degree of fluctuation in the case of interest rate changes, because bond prices and interest rates are inversely proportional. Whenever the prevailing interest rate goes up, existing bond price will come down. And if the prevailing interest rate comes down, the existing bond prices will go up. Like for example, in the last 2 months, 3 months, what happened? Like Dr. RG told in the introductory remark, RBI has resorted to hiking of interest rate. They have been increasing the repo rate in 3 or 4 occasions that they met, right? So what happened during this time? Sorry, the existing bond prices came down. The existing bond prices started coming down. So this is a inversely correlation, inversely correlated kind of a scenario. We need to understand that. So the interest rate scenario, allocate funds in a staggered manner if it is a rising interest rate scenario. As with subsequent interest increase in the rates, you will get a better yield. Concentration level in the portfolio, how much percentage weight is in the top holdings or sectors carry. Single group, company group exposure, right? And their credit standing, the schemes and the fund manager's track record, and the risk management process adopted by the fund house. There is also a familiar, recently this kind of funds are becoming popular. It's target maturity fund. So people who doesn't want to get into the interest rate fluctuation risk, they can adopt target maturity or they can start looking at target maturity funds. So what they do, they create a maturity strategy and adopt a roll down kind of approach where they won't trade on the paper. They buy certain instruments and they hold it till their maturity, which means in between interest rate fluctuation, you will have the effect on the NAV, but you will not be much bothered about it because you are going to hold it till the maturity. So as long as you are going to hold the fund till the scheme's maturity profile, you will end up making up that YTM in a more or less similar manner. So this is of late becoming a little popular because the interest rate scenario is very volatile in India, and we are also having a fixed income. Our fixed income outlook is also saying the same thing, that you RBI probably will be targeting inflation for some more time, I would say, rather than accommodating the inflation. Though they said a very positive statement in the last meeting that they would be supporting growth, but supporting growth in terms of the actionables, we need to wait and watch. But when they say targeting inflation, that means we can anticipate a volatile scenario to prevail for some time. So I think target maturity funds are good for people who are not very much keen, or then they don't want to get into the interest rate risk. So it's a very lengthy category in India, the debt fund. So you have about 16 categories. I told you in one of the previous slides that it is classified as duration based funds or instrument based funds, and this is the list goes like this. So all the funds that are classified by keeping the duration as a classification point, they all come under the duration fund. And anything that identifies by the scheme by instrument, they are called instrument based funds. So I'll just hold it here for a few seconds so that you can observe. All right, coming to hybrid funds, this is another category. So they invest in two or more asset categories so that investor can avail the benefit of both. They have different types of, we have different types of hybrid fund. They follow different asset allocation strategies. Prominent asset class combos are a mix of equity and debt. Some hybrid funds or some AMCs also add gold and international equity to it. Most fund houses uses an in-house valuation model to decide the equity exposure, when to increase the equity exposure or when to decrease them. And various hybrid fund categories follow very specific ranges for equity and debt exposure. And there we have about 6. They are called the conservative hybrid, aggressive hybrid, dynamic asset allocation, or balanced advantage. So as I told in the beginning, a fund house can offer any one of this, balanced advantage or dynamic asset allocation. Then you have multi-asset allocation, arbitrage fund, equity savings fund. So they all have a minor variation on how their equity profile and debt profile will look like. And accordingly, the return expectations also will vary. So this is the combination of the debt fund universe in India. A large among them, if somebody is interested in knowing, the large among them would be, I would say, dynamic asset allocation or balanced advantage fund category today is largest within hybrid, followed by aggressive hybrid fund. These two are large categories in India within a hybrid. Sorry. Coming to solution fund, suitable for goals like retirement, child's future, education, marriage, any of such goals that involves children. They follow a very conservative or aggressive style of fund management. Both are available, or something in middle also, conservative to aggressive. So moderate profiles are also available. So accordingly, we have two schemes here, retirement fund and children's fund. And then comes the other category called uh, others. So others is broadly consisting of four categories there. One is the other ETF, index funds, gold ETF, and overseas funds, fund of funds. So these are all the schemes that comes in others. So one question that may probably come to people is, if I'm planning for my retirement or children's future, should I choose a solution oriented fund, or I might as well plan with the equity fund? Right? My suggestion is you can also plan with the equity fund as long as you have the the thought process very clear that this is for retirement or this is for the children's future, and you will stick to the discipline of it. So as long as we do that, I think equity funds are perfectly fine to plan for the goals. So this is others. So if I have to put it in a ladder format, the entire MF categories that we have, probably I think this is how the ladder should look like. The risk return profile should look like. So the lowest risk or return expectation should be there in a liquid fund or something like that. And then you have the ultra short term funds. Somewhere in between medium term and ultra short term comes arbitrage. Actually, it is not a debt fund, but in terms of risk profile, it comes somewhere in between this. And then you have the medium duration funds, long duration funds, then you have conservative hybrid, aggressive hybrid. Somewhere here should come gold ETF, and then you have index funds which are equity oriented, and then you have the diversified equity, international funds, and sector or thematic funds. So if your risk profile allows you to carry any of this in your portfolio for your goal, you can think of doing that. Coming to taxation in mutual funds, for the sorry, for the purpose of taxation and mutual funds, the categories are classified by asset class into two. One is equity oriented mutual fund and non-equity oriented mutual fund. Then comes the duration bifurcation. So first is asset class wise. Once that classification is done, then all equity oriented mutual fund, any investment held for less than 12-month period is called short term, and that is taxed at 15% per annum, irrespective of the individual's tax slab. Coming to the investments that are held more than 12 months, first 1 lakh per financial year is exempted from tax. Exceeding 1 lakh, incremental gains are taxed at 10%. So in a financial year, if the entire gain made from all equity oriented investment for an assessee is 85,000, no tax. If it is 1 lakh 10,000, up to 1 lakh is exempted. The next 10,000, 10% on that 10,000 is 1,000 rupees. Plus surcharge, says whatever is applicable gets added. This is at the gross level, I'm telling, right? That should be the tax calculation. Coming to non-equity oriented mutual fund, any investment held for less than 36 months is called short term, and it is taxed as per the individual's tax slab. Any investment held for more than 36 months, uh, it qualifies for the indexation benefit, and tax is 20% after indexation. So now you already know what is that indexation. We just spoke about an illustration as per the cost inflation index. So it is taxed at 20% with indexation, all debt mutual fund, non-equity mutual funds, right? There is an element of dividend. I will just speak about it. So in dividend, what happened is earlier there used to be a TDS kind of a scenario, and fund house or corporates they pay, etc., etc. But in the recent budget, what happens is there is major change. So dividends are now going to be taxed at the hands of recipient. So that change occurred in the recent 2-3 budgets. So a quick recap of thoughts. Start with your financial planning. Point number one, set your goals, estimate the approximate future cost. You need not have to be accurate, but estimate an approximate future cost. Start with a destination. That is very, very important. And the duration by when it is expected. It is a short-term goal, it is a medium-term goal, it is a long-term goal. Only when you know the duration, you might be able to select the categories that are suitable for it, right? Equity markets and investments are prone to be highly volatile if viewed in short term. Equity outperforms other asset class in the long term. Yes, we saw that with some data. Short-term goals, plan through fixed income or conservative hybrid or balanced hybrid kind of a fund. And if it is a long-term goal, equity is good, like children's education, your retirement, etc., etc. Invest adequately and correctly. Have a well calculated SIP. That is very, very important. Well calculated SIP or investment. SIP is the best method to invest in equity because it is a volatile asset class. Any asset class that is volatile, systematically approaching them is a good idea. Continue SIPs when markets are down as you buy more units during that time. If you have surplus, add up during corrections. Review the portfolio periodically at a very reasonable interval. Take a term insurance for yourself. It keeps the family and the needs financially protected. Because please understand, if it is a goal, it is not, if I have a goal, it's not my goal, it is my family's goal, right? So term insurance helps a lot because life is full of uncertainty. At one point of time, investments along with term insurance helps a lot. So plan your goals well. Where we can help, we will definitely help you. So the first and foremost point I would like to highlight is we have a monthly magazine called Geojet Insights. It carries a good amount of loaded information with industry news and thoughtful articles. This is the link in which it's available. In this, we also have a recommended schemes on equity, hybrid, debt. So just now we spoke about different categories. Now you have a goal. You would like to now zero in on some schemes. How do you know the scheme? So just to put it in perspective, in India, you have about 1700 to 1800 schemes. Which one you will invest, right? The answer is simply given in that particular page. You can go to the recommended schemes, refer to the equity recommended schemes, hybrid recommended scheme, and debt. We don't have much of recommendations. We have rating. You can refer to the rating section. If any trouble in doing that, you can always get in touch with our branches or the customer care. They will be more than happy to help you. Our recommendation or this entire activity undergoes a strong research process. The idea is to give you a list of funds that are better placed in each of its category. That's the whole idea, right? And we also do a periodic review of the whole activities that we do. So Fundsgenie is another name I thought I will speak for a few minutes here. So it's a mobile app that's available for investors to make your mutual fund transactions. It actually made lot of changes were made in the recent few months. We have revamped this. The new Fundsgenie, we are already getting a very good feedback. We would encourage you also, please use it. Share your feedback with us. So just in a nutshell, it is 100% paperless account opening. KYC validation is done through the PAN. You can also directly get into the recommended funds of Geojit and all the top AMC funds, whichever you prefer that will suit you. And you can track your portfolio in that. In-depth portfolio analyzer. Portfolio analysis is a very, very interesting tool. It will give you an in-depth analysis of your own portfolio over a period of time. We also give access to the comprehensive reports about the industry, about funds that keeps coming every often. And you can also place offline orders. And both web and Android versions are available. Earlier, only the mobile version was available. Now we have the web version as well. So you can try and use it, and you can share the feedback. So with this, I would stop here. And if you have any questions, I can take along with my colleague, Dr. RG. Over to you, Jyoti.
Thank you, Sriram. We'll go on to the Q&A session. I think the first set of questions I will ask are for Renjith R G. The first one is NFO or regular running fund, which is better? In fact, I'd like to add a little more to that. We have received a question right now, which is what is NFO and how can we benefit out of it?
Audible?
Yeah.
Okay, so first and foremost, NFO is a new fund offer. Whenever a asset management company comes out with the offer, meaning if they feel that a particular sector they expect a particular sector or theme to do well, or a sector to do well, they come out with a new fund offer, wherein which normally it's will be up for subscription for almost 15 days. and it's available at a NAV of rupees 10. And those who want to subscribe to those NFOs can subscribe it, and post that they invest the money in stocks, and over a period of time, whatever is the return get reflected in the NAV. It's basically like buying. It's more or less icon with what used to have during the IPO days. It's NFO, new fund offer, and they will have a offer session, offer season, wherein which people may subscribe to the offer, and post that they will invest those funds, and uh, then it's a question of how well the fund is managed. To answer the question specifically, whether NFO, a new fund offer or existing fund, my view is that unless otherwise, this NFO offers you a proposition which is specific, which is innovative in nature, which is something which is novel. Ideally, my suggestion would be to go to a fund which is there in the market for a long time. Unless otherwise, the NFO offers you a proposition which is specific or novel or something which is path breaking. Why? Because as far as an existing fund is concerned, you have the track record of those funds for the 3-year, 5-year, 10-year. That will probably help you in identifying the right fund. Unlike an NFO, wherein which you don't have any past record, primarily because it's a new fund is there in the offering. You don't have any past record to substantiate their performance or gauge their performance against how well they have delivered the returns, how well they manage the funds vis-a-vis the market, vis-a-vis other funds, because vis-a-vis the industry benchmarks. So unless otherwise you have anything specific or particular or something which is path-breaking or novel, which is innovative, ideally I would suggest investors to go in for a fund with a track record and not NFO. Thank you.
The next question is again to Renjith. Isn't direct investing in stocks better than investing in mutual funds?
Just while going through the presentation of Sriram, it is apparent, it's very clear that how well our mutual funds have performed. It's 3-year return, 5-year return. The more you stay back in the mutual fund, the probability of making loss is almost not there. Meaning, if you stay back in the fund for 10 years, seldom you make a loss. Well, if you compare, it's basically it's not ideally. I cannot compare investing stock with investing mutual fund. Investing stocks basically, well, the return can be high, so as the risk, because you are taking a direct bet on a stock. So there is ideally actually no comparison whatsoever between investing in a stock and a mutual fund, direct stock and mutual fund. It depends upon a risk return preference or your risk profile or the kind of risk what we're willing to take. At the end of the day, it's nothing but your risk appetite or risk premium, what you are planning to give as far as investments is concerned. So it's something which is very personal in nature. If you think that you can withstand the volatility in specific stocks, then and if you're sure that you can identify stocks which will make you richer, which will probably be a 10 bagger, 20 bagger, 30 bagger, yes, definitely should go and direct invest in stocks. But at the end of the day, it's nothing but a confident. What the kind of confidence what we have got. On the contrary, if you want professional fund managers to help you augment or create wealth in the long run, you should ideally go and invest in mutual funds. So there's no direct comparison between investing in stock and mutual fund. Investing stock can riskier primarily because of volatility. You need to monitor the stocks individually. On the other hand, if you invest in mutual fund, professional fund managers are there to take care of your investments. They will monitor portfolio 24/7, and they have the backup of a lot of research analysts. They probably talk to the management. They have more information data than retail or individual investors. By virtue of that, in the long run, they tend to make a lot of money for it. That's apparent from what Sriram just said. You just went through, was going through the presentation. Sriram, like the Indian mutual fund schemes, all schemes have done phenomenally well. So it's a personal choice whether to invest directly or invest through mutual funds. If you have confidence that you can create wealth by, or you have the ability to handpick stocks which can create wealth in the long run, please go ahead and do that. Otherwise, much safer bet would be investing mutual fund, and that too in the long run, not for short term. Thank you.
Sriram, this question is for you. For retired customers, which scheme is better, monthly dividend option or SWP? And kindly explain the difference.
Okay. First let us understand what is this IDCW, that is the dividend option earlier, and now it's called IDCW. For the people who are new here, it is income distribution come capital withdrawal option. And then SWP is systematic withdrawal plan. Now, these two are different things. All right. So, in a scheme, most of these schemes, I would put it that way. Most of these schemes, we will have these two options, growth option and IDCW options. In IDCW, you further have two subcategories called reinvestment and payout. Now, uh, how this IDCW is decided is IDCW is a option that is declared by the fund house or the fund manager. I am using the word IDCW. Earlier, if I'm saying the word dividend, it would be very easy for me to pronounce it. So dividend at the choice of fund manager. Now IDCW declaration is at the choice of the fund manager. Now, if somebody would like to go with that, perfectly fine. But on the other hand, they have a regular income needs and they would like to have a steady kind of a inflow that is coming in from a particular mutual fund capital that they have invested. I think SWP is the right choice. Now coming to category, which category I should park my funds to do the SWP, right? So SWP, as I told, is a systematic withdrawal plan. So now the question is which category or the scheme that scheme we will come a little later. The most important thing is the category. Which category is suitable? Some people will even go for investing in a equity fund. But let me tell you, for SWP, what is the most important need? You are going to withdraw regularly, right? So that is you are trying to have a return that is coming periodically, and most immediately you will withdraw that as well. So it's the most important point is you should have a stability or visibility on the returns. That's the most important thing. So debt fund, low duration fund, medium duration, very rarely I would say, low duration with accrual kind of a nature. Those funds are good for SWP. Now, what should be the rate at which I should decide the withdrawal? That is the second important question. So I might as well choose to withdraw 10% per annum, right? Per annum 10% divided by 12. It's a little higher growth rate or the rate at which withdrawal rate at which you are working with, right? So I feel it's good to start with the expected return from that scheme where you are parking, point number one, and leave a margin of safety of say 50-60 basis point, in other words 0.5 to 0.6%, and remaining amount you divide it by 12 and go for a monthly withdrawal. So if your expected return on the scheme is say 7%, I will first minus 0.5% for margin of safety, 6.5 I will divide it by 12, and that rate I will apply to my capital, and that is the amount I will withdraw. Now, good thing about mutual fund is it is flexible, right? You start with a lower rate, allow the fund to build a corpus. In the subsequent 1, 2, 3 years, you can increase your withdrawal rate and get higher monthly inflow as well. That's a strategy that one can do. But I would suggest initial days keep it very conservative. Always have a margin of safety on the expected return. Then you decide the SWP rate. So if there is a very I would put it this way, that if there is a uh, compulsory requirement, you just need to use that money, or you need a monthly regular income, I think the ideal choice should be a debt fund or a conservative hybrid fund, and very rarely equity fund. And
That's really
SWP is good instead of IDCW. Yeah, please.
uh, another question that we gotten just now. How Geojit is helping their customers for suggesting the best funds to invest in.
This is to me.
Yes, Sriram.
Okay. Okay. So as I mentioned in one of my slides in the presentation, we have Geojet Insights, our magazine, and on a monthly basis we come up with the category-wise recommended schemes. So in equity, we just spoke, right? We have about like 7+ or 10+ categories. So every category, what are the recommended schemes from our side? So large cap, large and mid cap, flexi cap, mid cap, small cap. So each category wise, what are the schemes that probably one can look at within that category? We publish that on a monthly basis. So that's a very good starting guide for you. Decide the goal, decide the adequacy or the amount with which you feel that you can meet the goal. Uh, Look at the magazine, you can start.
Okay, the next question is SIP or lump sum investment in mutual fund, which is good? Sriram.
Okay. I would start by saying that it depends on the corpus, right? So if you are a person who already have accumulated surplus and you are trying to park that capital right now, then lump sum option is good for you. Next is the approach you should decide. Lump sum, you decided that I will put it as a lump sum, but the approach. Now, can I put all the money in one go? I would immediately look at the market. Like for example, I'm not trying to time the market here per se, but I'm just looking at the adjoining events around the market or the factors that are surrounding the markets at this point of time. It is always good to enter in a staggered manner. Unless otherwise, say for example, pandemic, right? March 2020, end of March 2020, beginning of March 2020, both are different, right? So if I'm in the end of March 2020, I might probably still invest staggered manner, but I would put maximum portion of my surplus at that point of time in the market because I know there is a reasonable magnitude of fall in the market, right? So that is one way of looking at it. Uh, on the other hand, if you are the valuation side, valuations are on the rich side, and you still have the volatility in the market continuing, and there are some new news, new fresh news emerging in the market. So for example, right now you look at this way, right? Somebody traveled from US to one of the East Asian countries, and the some neighbors doesn't like that, right? Now अभी वो क्या करेगा, मतलब what they will do now. No, these are all questions that are lingering. So what I will do, I will put it in staggered manner, right? I will choose maybe initial 25%, 30% to come in now. I'll wait for a while. I'll see how the markets are behaving, and then I will slowly get the remaining surplus into the market. Now, if I don't have a lump sum investment, right? I'm a salaried individual. I think SIP is fine. You are going to do fantastic over a longer period of time, my dear friend. Let me tell you, SIP is perfectly fine. You are a salaried individual, don't know lump sum. So lump sum is ruled out here. I am a salaried individual, right? I am going to invest my monthly surplus. So lump sum is ruled out for me, and I'm going to do SIP. And what we have seen over a period of time is SIP does wonders, right? So I think SIP is good.
The next question is which is the best small cap, mid cap, or foreign funds for investing?
Okay, first point, I feel you have already assessed and evaluated your risk profile and then found that mid cap, small cap, or international fund is something you can look at. Now, coming to the recommended scheme in Geojit, mid cap and small cap, we have recommended schemes. You can always refer to the Geojet Insight, or you can write to us. We will revert back to you, or you can get in touch with our branches as well. On the other hand, if it is international fund, at present Geojit does not carry a recommendation in that category. But nevertheless, what I would say is it depends on your way of looking at it, right? I was interacting with one more investor about a week back, same question. I don't want to name the scheme because due to SEBI regulations, if at all I'm using the name of any scheme or something, it's only for illustration purpose. It's not a recommendation. Unless otherwise, it's a recommendation tag carried by Geojit. All right. Now, which is good, S&P 500 or India, right? It's a very classic question. I would say that S&P 500 or Indian fund, first let us look at the number, right? So as long as your Nifty and associated index or the active funds investing in the universe of Nifty 500 or the ancillary and associated indices, right? If you are able to get a better CAGR in line with S&P 500, I think you might as well do with domestic indices, all right? Unless otherwise something extra that international fund is going to offer you. For example, there is a particular type of an index in the international fund or a index which consists of certain type of companies which you don't have in India only, right? Then you can actually add that to your portfolio because today you have a possibility. Sitting here, you can actually add S&P 500, Nasdaq, some of the European and American combo, indices, etc., etc. So you have that variation, or the, I would not say variation, that kind of variation with availability. You can always look into it. So, like my colleague Dr. RG told, first decide what extra that scheme is going to add to you, right? So as long as you are getting that extra, which you don't find in Indian market, I think you can add.
Sriram, the next one is in the long term, that is 10 years, which type of funds give a better return? Is it the index funds or large cap funds?
So if I know that answer tomorrow, my first investment is in that. I feel so it's a very I would say it's a very a difficult question to answer that way, because you're trying to predict for 10 years. So let me dice that, or if I'll break that into pieces. So first, let me try and see what over a 10-year period I'm expecting in India, right? I'm expecting over a 10-year period, Indian economy should do well, and the Indian corporates earnings should do well, and these two factors drive the market in the long run, right? In short term, reasons will trigger. The reasons or the events will trigger short term corrections in the market, but in long term, only two reasons market will go up, or market has to reflect, I would say, not go up. That's a leading word. Two factors will drive the market in the long run, right? One is corporate earnings and the broader economy. These two, if I'm very positive about India, then I would prefer to put it in equity, right? So I've decided the asset class, equity, I can invest now. How equity behaves over a period of time. So what we have seen is, in the long run, right, mid cap, small cap has a tendency to outperform the large cap and next large cap, right? Now, market cap, if you dissect that into blue chip, then comes the next blue chip, then comes mid cap, then comes small cap, then comes all micro caps, right? Because of the risk return profile, small cap, mid caps has a tendency to outperform the large cap group. All right. This is the general tendency. I'm not recommending any category here. I'm just telling the observation of the market, right? This is what we have observed. Now coming to the approach of that category, right? So today, increasingly, you have a wide scope, like what we see in the presentation. Also, there is a need. There is a scheme in India, mutual fund. There is a need for an investor. There is a scheme in India. One day, 1 week, 10 years, 10 plus years, everything is set, right? Now all it requires is decision, right? I would say mid cap, small cap, by the nature of that universe, because of the lack of information, or or I would say the risk of the information flow, it is better to approach that through the mutual fund route. Large cap, you might as well do active fund, index, ETF, stock, reasonably kind of okay, because you have a better information flow that is trustable also. So that is the whole point. So 10 years, higher return, and patience is there, discipline is there, intermittent market volatility, you will only see, don't do anything. I think mid and small cap somebody can prefer, but their risk profile should permit them. So that is the whole idea.
One last question before I let you off, Sriram. How long should one wait to start an SWP out of a fresh MF lump sum investment, that is equity MF investment?
Equity MF investment is the word that sometimes will change the whole answer itself, because you are saying equity MF, and how long you have to wait is a reasonably good statement, because you are allowing the returns to accumulate. But I would say, what if your waiting period market went up and your withdrawal period market came down? You can't predict that, right? So if it is SWP and there is a compulsion of consumption, see, that's the most important point here. If I am going to adopt a SWP, and the reason for that is I have a consumption lined up after that withdrawal, I would prefer a non-equity. As I told in the beginning, I would stick to accrual type of debt fund, or conservative hybrid funds. Equity savings is one category one can look at. In equity savings category or a conservative hybrid, you wait for about like 10 months, 1 year, then start your withdrawal. Reasonably fine. Arbitrage you can, but arbitrage, the returns are very low and it keeps changing. Sometimes returns are very reasonable and reasonably solving the purpose or serving the purpose. Sometimes returns are too low. I mean, you can't decide upon it, right? So I think it's better to stick to the conservative oriented funds. In equity, yes, it works. Like for example, in aggressive hybrid fund, we have instances where people waited for the first 1 year, say 18 months instead of 12 months, say 14, 18 months, and then start the withdrawal. Things have been fabulous, in fact, over a 10-12 year period. But there is an element of risk. All right. So everything depends on the consumption. So if my consumption can wait, I don't have a dependability on this SWP for a consumption. I can even choose equity fund because I can pause anytime, I can wait, I can restart, all these things I can do.
Thank you, Sriram. That was the last question we will be taking because we are out of time. We're still receiving a lot of questions. So I'd like to tell all our clients who attended today that we will be answering those questions. We will email the reply to you. So before we wind up, Sriram and Renjith, is there something that you want to tell our listeners today?
So first and foremost, I want to thank all those who have participated in this webinar. And point number two, the inherent nature of equity market is volatility. Markets are volatile. You cannot do anything. There's no two ways about the same. But what is most important is what we have shown in this presentation. Good returns can be made, as Sriram rightly said. If your time horizon of investment is 1 year or less than 1 year, 2 year, ideally equity markets is not right space for you. You have to give time for the markets to fetch you returns. And SIP is a fantastic tool to which we can make superlative returns in the long run. It's apparent from the presentation. The beauty is that all those presentations are based on actual data. The data suggests that if you keep investing in the long run, maybe as far as SIPs are concerned, if SIPs are more than 10-year-old, the possibility of making loss is almost nil. We now make a loss if your investment horizon is 10 year, yes, shown in the presentation. So please make sure they're keeping invested, stay invested. SIP is the ideal way, ideal methodology through which you can create wealth in the long run, primarily because if the market tank, you know that you garner more units. When the market goes up, you tend to make capital gains or super returns out of that. So stick on to 2 or 3 or 4 or 5 good mutual fund plans. Don't shuffle or don't look at the NAVs on daily basis. Give your fund managers time to perform. Maybe in a year or something, you can probably go and review the performance with the help of your financial advisor and have suitable modification to portfolio. Don't look at the market daily. And whenever the market tank, whenever the market correct, kindly don't go and stop your SIPs. That's the first thing what we can do as far as wealth creation is concerned. So whenever the market tank, ideally speaking, if you invest in the Indian growth story, you can ideally go ahead and increase your monthly installment as SIPs are concerned, but never ever stop your SIPs. If you stop your SIPs in other way, you're making certain that your wealth creation is going to stop. In other words, never ever sell unless again, first we said, if your horizon is 2 to 3 years, please don't come to capital market. If you are staying invested 5, 10 years, what you should ideally do is that if the market tank, ideally speaking, you should increase the SIP, numbers. And also, one thing you should always remember is that your savings and investment has to be aligned. Meaning, if you start your, say, for example, if you're earning 100,000, you say 10,000. Ideally speaking, when you earn 200,000, your investment should also rise in tandem along with your rise in the earnings. So what is ideal here is a step-up SIP, meaning every year you can increase the SIP amount by a particular percentage or a particular amount. And point number two, the ideal question, when is that somebody should stop the SIPs? You should stop the SIPs when you realize or reach your financial goal. Each and every SIP has to align to a goal. Otherwise, there is no fun in investment. It has to align to a goal, maybe buying a new car, a vacation, or your daughter's marriage, your son's education, whatsoever. It has to be aligned to goal. And when you reach the objective, you can go ahead and stop the SIP and probably shift that wealth, what you have accumulated, to SWP plan so that you can relish the benefit of the investments what you've made in the long run. So please don't stop your SIP when the market correct. Increase your SIPs, stay invested for the long run. I'm sure that in the long run we all will make profit. Thank you very much once again for being a part of this webinar. Over to you, Sriram.
Yeah, well, thank you, sir. And I would like to thank all the participants for joining in, taking your time off your schedule and joining in this for webinar. And I hope some of the information that we have shared might be useful for you. And we would be eager to listen to the feedback from you. Or just in case if we missing covering something in today's session, you can always write to our the ID that my colleague Jyoti had given. We will try to cover that in the future sessions. And before winding up, on behalf of all of us, probably in this webinar, I congratulate the Indian contingent that went to the CWG Commonwealth Games of 2022. Fantastic show, 61 medals, 22 gold. I think this is the peak of the performance that our sporting team had ever given in the international space. I think this is a fantastic show. So all the congratulations and wishes to all the sporting champions who represented India over there. So coming back to the session, so we just say the same thing. Just stick to your goals and keep investing. I think you will be remembering the whole activity for good over a period of time. So wish you all good luck and happy and healthy life. Jai Hind. Thank you.
Thank you,
Over to you, Jyoti.
Sriram. Thank you, Ranjit, for taking time off and speaking to our clients. Thank you all for joining us. And in case you have any more doubts or clarifications, you can always write to us at communicate@geojit.com and we'll be happy to reply to you. Thank you all.